What explains the huge divergence between the economy and the stock market? On the one hand, we've got inflation, we've got job losses, and a generally negative mood, juxtaposed against a market that has set records only to be exceeded by international markets and gold, which have outperformed the US market. Paradoxically, last quarter and year to date, bad news is good news for the market. The Fed saw the unemployment rate and decided to reduce interest rates, which adds fuel to the market. Additionally, the unemployment turned into wider profit margins for companies in the S&P 500. The inflation narrative allowed them to raise prices, so they boosted revenue. 7 stocks account for 40% of the gains in the market. It happens that these stocks are also focused on their AI spend, and the artificial part of artificial intelligence means that it's very disconnected from the real economy. During 2025, we had triggers that would lead people to sell the cash, and we also had triggers that would lead people to take excessive amounts of risk. We were able to navigate a very narrow third path that did not take excessive risks, but still participated in the market, resulting in excellent risk-adjusted returns. Looking forward, I'm asked often 2 major questions. The first is, what is going on with the data? We saw a job revision last quarter that was very dramatic, showing that the economy has created far fewer jobs this year than it needed to employ all the recent college graduates and other people who wanted to get jobs. Is something broken with the measurements, or is there something else going on? The answer is that the way the data is collected, there's a lagged effect, and the lag is focused on small businesses that tend to be the first to fire and the last to hire. Consequently, when the economy is at a turning point, you're going to see differences between what they estimate in the data and where the data actually ends up. Should the executive branch tamper with the collection of economic data, then we might have a problem where the actual data itself leads to policy decisions that are not based on the correct information. We focus on the Fed, and I'm often asked what happens if the Fed loses its independence. Also, this is problematic because central bank independence is central to the support of our currency and our economy. Right now, with this last lowering of interest rates, rates are about where they should be, which is 1% above the inflation rate. However, lower rates would be loose money. And when you have a time when the fiscal side is printing money, there's only one outlet, and that's through the dollar. And the dollar would continue to go down, which would boost international stocks, and it would boost gold. The last time this happened was in the late 60s, and the consequence was the dollar depreciated so rapidly that we had to suspend the gold standard. So dramatic things can happen. There's an old adage that understanding markets requires you to understand math plus Shakespeare. And certainly this year to date, we've seen the math get trumped by Shakespearean types of drama. We continue to work hard and take it day by day to chart the right path through these turbulent times, shepherding the assets of our clients. We want to thank you once again for working with us, and I want to let you know it's an honor to serve you, and I hope that the end of the year goes well for you and your family.